And joining us now from Bengaluru, India, is Anupam Manur, Professor of Economics at the Takshashila Institution. Good to have you with us, Anupam. Now, India has more than 100 million retail investors. How are they navigating the market volatility triggered by these trade tensions between the US and China?
There has been a bit of market correction and much greater volatility. The Indian market is seeing a range of 0.5 to 1% swings on an almost daily basis. The most recent downfall, which is happening as we speak, is due to the tensions between India and Pakistan. The market is overall below the peak levels that it reached in September 24, but is still in very healthy territory. Overall, the losses in India, if you can see, is been much lesser than the ones that that's experienced in the US. There's not been a big sell-off as such in the Indian markets, and each time there has been a downfall, it has been quite quick to bounce back. So investors are broadly adopting a wait and watch approach. Investors are also probably looking at alternative investments such as gold and other commodities, given that there's been a surge in gold prices, which are traditionally considered safer than the equity markets. At the margin, real estate investments will also increase going forward.
Right, and are we witnessing a necessary course correction, as you say, or do you see further trouble ahead?
It doesn't seem like there's any deeper trouble. Valuations in the market were quite high due to the irrational exuberance in the Indian markets, and there's been a slight corrective tendency even before Trump and the trade war began. But this does not point to any structural readjustment. The Indian equity markets are still a bright spot in the world, which promises good returns and reasonably high growth. All other indicators of the Indian economy, whether it is GDP growth, macroeconomic indicators, inflation, are all still looking good. Given that most of the tariffs that Trump has imposed affect all of India's competitors, India is even looking at this as an opportunity if the government can get a trade deal with the US. If we go back to the 90-day pause that Trump has imposed, or the period just before that, India experienced tariffs of about 26%, whereas most of other competitors, let's say Vietnam, etc., had much higher tariff levels of 46%. So you could be mistaken to almost be optimistic about this scenario in India.
So what makes Indian retail investors more resilient despite recent portfolio hits?
I think there's a fundamental belief in the Indian growth story, and that has not gone away. India is still the only major economy in the world that is poised to grow at 6 to 7% in the growing year, and at least for the next, for foreseeable future at least. There are a lot of positive indicators. As I said, government finances are consolidating post-COVID. Inflation is broadly under control. The central bank is looking to cut interest rates. Many industries are beginning to look good. Credit offtake is looking good. Consumer confidence is high. I think all of this points to an overall optimistic story despite the recent turmoil. There's also a realization, perhaps, between investors that FIIs, the foreign institutional investors, especially many European pension funds, do not have a lot of other opportunities in the globe. And India can provide them with the returns that they require. Investors are looking at selling US assets, as we're seeing that the dollar is weakening, and are looking for other opportunities. Chinese economy is not looking good. Many Southeast Asian economies, which are heavily dependent on trade, is looking, again, slightly in turmoil because of the trade war. So I think in all of this, again, India is poised to look good. India's Nifty, if I'm not mistaken, is the third best performing market in Asia after Taiwan and the Nikkei markets.
Right. Professor Anupam Manur from the Takshashila Institution, thank you very much for joining us.
Thank you. It's a pleasure.